Do you know what is the most annoying part of investing? You watch a stock, it is growing, and it looks like it will never fall. You do your technical or whatever analysis, and everything indicates that the stock will keep rising. The moment you decide to buy the stock, it crashes, it starts falling. You might not have realized that, but the moment you actually spend your money and buy a stock, you will pay attention to that. It might rise back, but quite often, the moment you purchase the stock, it instantly starts going down. Have you ever wondered why? The obvious answer is the market. That's how the market is. You can't do anything about it. The laws of demand and supply determine the price of the stock. So if the stock is falling, it's because more people are selling it than buying. Technically, that is true, but quite often, that is not the case. It's a bit more complicated than that. What if I told you that the market is designed in such a way that no matter what stock you buy, it will most likely fall the moment you buy it? When you want to buy a stock, you will most likely pull up your phone and do it through an online broker like Robinhood, TD Ameritrade, Webull, or any other broker. You can't directly get into the market and purchase stocks from companies, since everything is done electronically and most stocks are sold on the secondary market. But what if you're a huge investor? What do? And you want to buy 1,000,000 Tesla stocks at $720. If you put that big of an order into the market, everyone is going to notice that, and they will also buy Tesla stock, hoping to profit from the stock spike, driving the price higher. So you will not get all of your stocks at $720. Or vice versa, what if you want to sell 1,000,000 Tesla shares at a specific price? That is going to drive the price down. So to make sure that you get the best possible price, you're not going to directly buy that many stocks, but call a financial institution to help you with that, such as Goldman Sachs or JP Morgan. JP Morgan is going to contact other investors and collect sell orders to get 1,000,000 Tesla shares at the best possible price, which is, let's say, $720. And that is called a dark pool, which is not regulated or accountable to anyone. But sooner or later, the transaction is going to appear on the open stock exchange when it happens, and the stock will spike. However, the big investors have already purchased 1,000,000 stocks. Dark pools are specifically designed for such purposes. Dark pools are much more common than you think. According to CFA Institute, non-exchange tradings have recently become more popular in the US. Estimates show that it accounts for approximately 40% of all US stocks trades in 2017. Compared to an estimated 16% in 2010. And guess who else uses dark pools? Exactly, Robinhood, where most retail investors who are watching this video buy stocks. You can make a case that there is nothing inherently bad with the fact that Robinhood uses the dark pool, and you would be 100% right. But things are not as simple as they might appear at first glance. Since dark pools are private exchanges for trading securities that are not accessible by the investing public, we don't know everything that's happening behind the scenes. But what we do know for sure is that a vast part of Robinhood's revenue comes from selling your trades to hedge funds. Since the invention of the stock market, hedge funds, investment banks, and institutional investors have tried to come up with different ways to predict the market. Once you know which stock is going to rise, you have a guaranteed way to make money. Just buy that stock, wait till it spikes, and sell it. And boom, you've made money. It's as simple as that. And vice versa. If you know that a stock is going to plummet, all that is left for you to do is short it. That is why inside trading is banned, because inside trading gives you an advantage over the rest of the market. You know for sure which stocks are going to rise and which ones will fall. However, Robinhood has revolutionized the industry. When you buy a stock through Robinhood, you're not buying it directly from the open exchange, but rather through Robinhood's dark pool. and then it will appear on the stock exchange once Robinhood sends your trades to the open exchange. However, before sending them to the open exchange, your trades are sent to hedge funds. So hedge funds technically know which stocks are going to rise. Let's say there are thousands, if not hundreds of thousands of purchase orders on Apple stock from different investors in Robinhood. It will slightly push the stock to spike at least. So hedge funds would also buy Apple stock right before it appears on the open stock exchange and instantly sell it when the stock spikes. This all happens in a fraction of a second. It is called high-frequency trading. It's a trading method that uses powerful computer programs to transact a large number of orders in a fraction of a second. It uses complex algorithms to analyze multiple markets and execute orders based on market conditions. In plain English, Robinhood sells your trades to hedge funds, which uses these data to buy stocks before it appears on the open exchange, and then sells them the next moment, bringing the stock down again. Because hedge funds are the ones who are actually making a profit from this deal. Of course, individual trades don't make much of a difference, but Robinhood has over 22 million users. Collectively, their trades can move the market. And secondly, hedge funds don't make astronomical returns on these high-frequency trades. Margins are slim. It could be from few cents to a few dollars. But when you combine them together over time, they turn into hundreds of millions of dollars, if not billions. Over 50% of Robinhood's revenue comes from selling users' trades. That's how Robinhood manages to keep its platform free. So a wise man once said, if the product is free, then you are most likely the product. Robinhood has already been sued for its shady practices. Instagram, Facebook, and Google are free, but your data is sold to advertisers. We can criticize Robinhood as much as we want, but there are really no alternative options. Webull, Ameritrade, and other brokers do sell their users' trades as well, so you're left with no other option but to accept the harsh reality. However, if you're a long-term investor, then you should not care about such things, since what you care about is where the stock will be a year from now or longer, and not a few minutes or seconds or milliseconds later. Does that mean there is no point in trading since we have supercomputers that have access to information that you and I don't have? The answer is yes and no. There is still money to be made if you're a retail investor, but you should keep in mind that you're always behind the hedge funds. Hedge funds pay premiums to brokers such as Robinhood to access that kind of data. Of course, this is not the only reason why stock prices fall right after you buy them. There are many more reasons, since the number of factors that influences the price of any stock are beyond what we can discuss in a single video. But the fact that most retail investors use brokers such as Robinhood is one of the main reasons. If you want to understand the world of the stock market, you can always check my stock market course on Skillshare. It's simple, straight, and you can get it for free if you use the link in my description to sign up for Skillshare. There is going to be an assignment at the end of the course, which I will personally check and provide you with feedback. What do you think about Robinhood's business model? Do you think they have the moral right to sell your trades in exchange for keeping the platform free? Let me know in the comments below. That's it for today. Thanks for watching and see you in the next one.